I've been investing in the stock market for almost a decade, and sometimes you can spot patterns that come once in a while to be in your sweet spot of what you like. These sweet spots give you the opportunity to swing hard so you can compound your wealth at a very good return. Thanks to these sweet spots, I have averaged a performance of roughly 25% per year, and I plan to continue to find these sweet spots. And I believe that Fortinet right now is exactly in this category. Fortinet is a company in the cybersecurity industry, and they will report earnings this week on Thursday. If there is any price drop and the company is doing a massive buyback program, I plan to increase massively my position in Fortinet. I believe this is one of the golden opportunities we have in this current market today, right now, for a few reasons. But before we go deep into the numbers, I want to show you how I think about this portfolio I have, how I think about my portfolio, and how I believe I can make 20% per year. Because now we know the worries we have in this world. Let me write a little bit. We have 2026. We have a few worries. Let me put worries right now in 2026. We have AI that will shock the world and that is creating a lot of uncertainties. What I want to say is you have big companies in this world like Microsoft, Google, Amazon, Meta Platforms, but plenty of other tech companies. They are increasing their guidance for CapEx. The AI implementation is generating a massive surge in CapEx, massive surge in costs. If you look at Meta Platforms, their margins are down because they are hiring people and investing a lot to implement AI everywhere. The revenue growth is reaccelerating, but the costs are up a lot. And Meta Platforms is one of the best business models on earth. If Meta Platforms is having temporary setbacks when it comes to their profitability and efficiency, you can imagine what is happening for mediocre businesses. AI is a big thing that is accelerating right now, moving faster than ever, accelerating in 2026 compared to 2025. So the discrepancy between revenue growth and margin growth will increase. And I want to take advantage of this for my own portfolio. Okay? How can you benefit from this situation? Now that you know that AI will change the world and the tech companies are increasing their capex, what can you do? Well, these were the worries in W, and let me give you the benefits, how I am managing my portfolio. And that gives me the first rule of my portfolio is to not invest in companies that have a high capex, is to only invest in asset light businesses, ALB, asset light businesses. Sorry for the bad writing, but you get my point. And you have a few companies in this world that will benefit from AI, will benefit from the economy growing, but they don't incur any costs. They don't have any capex. I can give you some examples. I can take the example of Adobe. Adobe is in the lucky position of implementing AI with their Firefly, etc., without having any capex. They can generate a lot of cash flows, and instead of reinvesting the cash flows into the business to make their own data centers or something else and whatnot, they can use this cash flow to do buybacks. Use this free cash flow to do buybacks and reward shareholders, which is exactly what they're doing. You have other businesses like FICO, Fair Isaac, that is doing this. If the world is getting better and the US economy is growing faster than ever, the tech is advancing, the growth GDP, etc., FICO will benefit. And FICO has a software tool and they don't have any capex. So FICO, Fair Isaac, is a business that can grow earnings at 20% per year with zero capex. Almost zero capex. I can give you a third example. I can give you the example of TPL, Texas Pacific Land, and a fourth example, Landbridge, ticker symbol LB. If AI rules over the world, if the economy is reaccelerating, if for some reasons you have data centers being built in Texas, landowners in Texas will get royalty streams. And if for some reasons you have a surge in AI demand, a lot of capex, TPL and Landbridge have a business model with gross margins of 90%. Extremely profitable business model, zero capex. If AI rules over the world and you have data centers in Texas for some reason, in Permian Basin for some reason, it's just upside and zero downside for TPL and for Landbridge. By the way, the ex-CEO of Google, Eric Schmidt, just announced a partnership with TPL. So it's not crazy, ludicrous, delusional to think that data centers will come in the Permian Basin. You have some very well informed people that are investing in this theory. So maybe you have what, a 10% chance of it happening, 5%, 10% chance of it happening. If it happens, TPL will print cash. So a good way to stay ahead of the curve and generate 20-25% per year is to only be invested in these risk-reward opportunities. I've given you 4 examples. I believe Fortinet is a good example of this. This is my 5th example, because if you look at Fortinet, you can go to the financials. I can navigate on Fiscal AI and show you what I mean. You can check the cash flow statement of the business, the operating cash flows that Fortinet has generated for the past decade, and you can look at the capex. This is your line. You have a large line in red and a minimal line in blue. So as the world is getting more digital, more tech, more AI driven, Fortinet has very low capex. This is how I want to build my portfolio. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second worry we have for 2026 is, first worry was AI. Second worry is inflation. Let me put a big I for inflation. If we live in a world with inflation, 2%, 3%, 4%, 5%, in case inflation rebounds, I believe we will have inflation. I only want to be invested in companies with nice margins, high gross margins, and pricing power, which means I only want to be invested in companies that can raise their prices. You have a moat, you have stickiness from customers, so you can raise your prices and customers will stay with you. So the benefits is, I want high gross margins, GM for gross margins. Okay, I can show you the gross margins of Fortinet. I can show you income statement, gross margins. We are talking about a business model with gross margins of 80%. A gross margin profile that is high, 80%, shows you have pricing power. And all the past examples I've given you are right. Adobe has gross margins of 90%. FICO, TPL, Landbridge, very, very high gross margins. Okay? Third thing, if you think AI will rule over the world, you want to be invested in growing industries. So a worry people have is, what is the uncertainty we have regarding AI? How will the world change? Will AI destroy some businesses? Will AI reaccelerate growth in some industries? I only want to be invested in growing industries. So, this is a good segue to AI, but when it comes to growing industries, I can put, not a G actually, a G would mean growing. That could be the benefits, growing industries. I can put a small I for uncertainties. So many I's on this video. For all these uncertainties when it comes to the new world, how do I want to be invested? I want to be invested in growing industries. And I think right now, cybersecurity is an industry that is expected to grow immensely thanks to AI. And I believe that is not priced in. If you check on Statista right now, if you check the internet, they will tell you that the cybersecurity industry is expected to grow between 10 and 12% per year. The AI-driven cybersecurity market is expected to grow at 25% per year. You can check history, you can check the track record, you can check what the estimates for the cybersecurity industry growth rate were in 2017 and come back to this video. I think the estimates can vary widely, and I think these estimates, the growth rate for the cybersecurity industry of 10-12%, are too low. So I think the entire cybersecurity market will grow at more than 12% per year. And this is why I want to increase my exposure to Fortinet. I only want to be invested in growing industries, profitable industries, and I believe the estimates from Wall Street are too low. If you check what the management team of Fortinet said, they said we have always grown above the market average. If the market is growing 10% per year, we will grow revenue at minimum 10% per year. If the market grows at 12% per year, we'll move at minimum 12% per year. This is your minimum, this is your threshold. Now, as I told you, the market expects the cybersecurity industry to grow at 10-12% per year, but I think it will grow more than this. What is Wall Street expecting from Fortinet? For the Wall Street, if you look at their estimates on Fiscal AI, by the way, you can use my link in the description to have a discount code at 15% to use Fiscal AI. You can check this website 2 weeks completely for free without putting your credit card to try it out. It's a wonderful website. I'm using this on a daily basis. Please check the link in my description and sign up for Fiscal AI. Anyway, for the revenue growth rate, Wall Street thinks that for 2026, the revenue will grow at 11%. And for 2027, the revenue will grow at 11%. I think both these estimates are wrong. I think both these estimates are too low. And I think Wall Street will be shocked to see the reacceleration of the cybersecurity industry. So when this company reports earnings on Thursday, it's quite likely I will buy more, actually. I have a few things to monitor. I have a few KPIs to monitor. And for example, the buyback program or the margin profile. But it's highly likely I buy more. If the stock drops a lot, I will buy more. Now, you can check the valuation of Fortinet. You can check the past growth rate, the past guidance. You can check the revenue. I mean, for the past 10 years, we are talking about a business that has grown revenue at 22% per year. And now we are at the beginning of this AI agent thing. AI will reaccelerate the whole world, the whole digital world. AI will change the way we use the internet. You will have many more AI agents, many more breaches of security. All the CEOs in this cybersecurity space are saying the same thing. I'm checking all the interviews of CrowdStrike, Zscaler, Palo Alto, Fortinet, Rubrik. Everybody is saying the same thing. Things are moving fast and things are reaccelerating. The market needs a lot of defense because hackers can now hack a system not within a couple of minutes, but within a couple of seconds. You have to be ready. So I think the demand for the whole industry is expected to grow massively. And we're talking about a profitable business. On average, it has grown revenue at 22%. And now, given the high plateau we have reached in 2021, 2022, because of the refresh from COVID, the business has slowed down. Because, the business surged during COVID, so you have a reversion to the mean. The business is back on track to grow double digits, and Wall Street is not feeling it. Wall Street does not like this business. They think that the business will never grow at 15% plus or more. Wall Street thinks that the revenue will stay at 11% per year for 2026 and 2027. Now, if you look at the latest data, the revenue has already rebounded. The revenue is growing at 14%, 15%, but Wall Street is not convinced. I will gladly take the other side of the bet. I would gladly invest more. I would gladly make Fortinet one of my core holdings, biggest position in my portfolio, because I think Wall Street is wrong. Or maybe I'm wrong. Don't blindly follow me on this trade. Please do your own due diligence. Maybe I'm wrong, okay? I don't want people to watch my video and do zero due diligence and buy the stock and then complain because they have not done their homework. This is just the starting point of your analysis. The journey is just starting. Please do your homework now. Now, if you look at the valuation, I created a custom metric that can give you some information. I created this custom metric that I'm sure you will like. The EV to free cash flow, excluding SBC. Or even the EV to free cash flow. This one, operating cash flow, free cash flow. We are talking about similar lines actually. You know what? Let's be conservative and use this line in blue. The blue just became red. This is your EV to free cash flow. So that's like the price to free cash flow, but you take into account the net cash because the company is net cash. They have more cash than debt. And you exclude SBC. So you exclude the stock-based compensation, the stock options that the company is giving you. By using this ratio for multiples, we are being conservative. And we are using the free cash flow because the company is expecting to grow the capex a tiny bit. Anyway, this metric, I believe, is the best valuation metric when it comes to Fortinet. If you look at history, it is widely fluctuating. Sometimes it goes down to 20, like we had in 2019 and also like we had in 2020. By the way, the drop you see in 2023 has to be adjusted. It is not in reality 20. It's a little bit above than this. Fair enough. Let me be ultra conservative in the numbers I look at. And on the high end, this ratio it was below 19 here. And at the maximum, it's 55. So let's say between 20 and 55. And now we are perfectly at the middle of this range. The average of this ratio has been 33. The median of this ratio has been 31, 32. I bought Fortinet at different instances. By the way, guys, I bought Fortinet in, I believe, November 2020. And I sold on the way up here. This is not the first time I'm buying Fortinet. I've been following this company for more than 5 years. So I have pretty good conviction in this company as a whole. If you look at history, the valuation is widely fluctuating. And I am buying back. I am back on the train because I first bought some stocks in August 2025 when the stock dropped. The valuation was very high and it came back to reality. The valuation dropped to this ratio of 30. I bought the dip and then I bought a second time again. It's September at a ratio of 31. Now, if you look at, what do I have here? Why is the valuation stopping at September 2025? Interesting. Let me show you the real number. September 2025. Oh, that's funny. Oh, I think this is pretty much it. Yeah, that's one. Okay, so I bought the dip when this ratio was at 30. I bought again the second dip when this ratio was at 30. And now we are at the same level, 33. The stock has recently rebounded because there was an analyst that upgraded their price target. So the stock went up like 5 or 6%. Anyway, we are reasonably priced right now for a business that is expected to grow reasonably. But I think the business will not grow reasonably. I think the business will grow a lot. People expect the business to grow at 11% per year. I don't think this is true. I think the margins will go up. I think the revenue will go up by more than 11% per year. I mean, if you have a revenue growth rate that is not at 22% per year, on average for the past 10 years, the revenue has grown at 22% per year. If the revenue grows at what? 15% per year. Let's say it grows at 15% per year. which is being conservative based on what we said before. If you have small margins improvement for this business and the business is continuing to do buybacks, we are talking about free cash flow per share growth that is on the high end of double digits. And you can use Stock Unlock, another website I recommend to you, to calculate an intrinsic value. If you think the free cash flow of the business will grow at 15% per year, let's say the free cash flow grows at the same rate as the revenue, you have no margin improvement. And let's say the price of free cash flow stays at 30. I mean, you have to make a small adjustment here. Let's check the price to free cash flow of this business. Price to free cash flow of this business right now officially is at 30. Okay, let's say the valuation is the same. This is your evolution of price to free cash flow over time, by the way. Yeah, let's say the price to free cash flow stays the same. The free cash flow grows at 15% per year. You have no margin improvement in the future, and the company is doing a 2% buyback yield, which they are doing right now. If these are your estimates, then the stock price is 35% undervalued today. And if you buy today, you can generate a performance of 17% per year, based on the scenario that the free cash flow is growing 15% per year. If you look at this stock chart, this is your free cash flow over the past few years. Do you believe, first question, do you believe the cybersecurity industry will grow? Yes or no? I think yes. Second question, do you think it will grow at the same pace as in the past, or will it reaccelerate? Do you think it will grow at 10% per year or 15% per year? Second question, I think it will reaccelerate because of AI, and I think immensely. Third question, do you think Fortinet will grow more than the industry average, or the same rate as the industry average, or below average? Historically speaking, Fortinet is growing at a minimum rate of the industry average. Based on these three questions, you can estimate the growth rate of Fortinet. Fourth question, do you think margins will improve in the future? You can look at history. You can look at the margin profile of the business. You can go to margins, gross margins, operating margins. What can you see? If you look at gross margins in orange, this is what you have. 10 years ago, the gross margins were at 70%. And now we are at 80%. And if you look at the operating margins, you can spot the same trend. Something that is growing up and to the right. Yes, the company will invest more some years. The free cash flow will be down because of some reinvestments for some reason. But operationally speaking, the business is getting better. So maybe in the future, you can expect these two margins to go up. If the revenue is growing at 15% per year, maybe the earnings per share, the free cash flow per share, will grow at more than 15% per year. If we take this simple adjustment and you expect the free cash flow to grow at 17% per year, a 2% buyback yield, then if you buy right now, today, the CAGR, the compound annual growth rate you can expect is 19% per year. I don't know if they will grow at 17% per year. Nobody knows. This is your crystal ball. It's you and your own conviction. This is when anyone has to do the work, has to do the homework. But I could really see a bullish scenario where the free cash flow of this business grows. They are doing buybacks and the business can generate 18, 19, 20% per year. Because I am having this philosophy for my whole portfolio of 2026, I can find specific opportunities that can grow roughly 20% per year. And I believe Fortinet is a golden example of this. We are in the prime age of AI. People have sold these stocks because of the software stocks drama. You have a bloodbath in software, and people think vibe coding and AI will disrupt cybersecurity companies, as if people would vibe code their own cybersecurity plans. I think that's quite delusional to think this. We will see. But I'm taking a big position here. Maybe I'm wrong, maybe I'm right. Don't follow me on this trade. But yeah, do your own due diligence. But I plan to massively increase my position in Fortinet. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.